Hello, Tuesday, July 28th. Boy, the year's going fast, isn't it? Just give you a quick portfolio update on how things are being constructed and where we're headed and why. Economically speaking, we are in the early innings and early stages of stagflation. Um, Stagflation is, for the most part, not a great place to be economically. It's that kind of an environment where only certain kinds of asset classes do well, and most of the time they're not general equities. There are pockets of equities that will do well, and we'll certainly be able to take advantage of that. But for the most part, it's focused on low to no growth with lots of inflation. So sadly, 52 million unemployed people in this country are going to have to be facing an increased cost of living kind of across the board. And we're seeing that in, well, just about everything. Anyone who's attempting to build a home right now knows that the cost of lumber has just gone crazy, basically up about 50% in just the last few months. And it doesn't look like it wants to slow down, at least in the near term. But what is happening is everything's very closely tied to what's happening with the dollar. The US dollar is experiencing a pretty massive sell-off right now. Some have called it a collapse, and I would be in that camp because it looks like a collapse. It collapsed in March. It recovered strongly. You'll remember we were bullish on the dollar until about the end of May, and then we became very bearish. And in fact sold our long dollar position for a small gain and then ended up shorting the US dollar. I covered our our short dollar position last week because it became very heavily oversold and an extremely crowded trade, meaning everybody and their brother who's an investor and trader was short the US dollar. That's usually not a great place to be either. The old mantra, beware the herd at extremes. So we covered our U.S. dollar, our dollar shorts, and are going to kind of wait for a spike or a bounce to happen. And when that does, it'll give us an entrance opportunity into a number of things. So in a stagflationary environment, the things that typically work well are real estate. We have to be a little bit careful of the real estate segmentation now, only because the whole work from home environment is, I think, rapidly changing the face of what corporate real estate looks like. But residential real estate right now is a much different picture. So in a stagflationary environment, typically real estate, utilities, and tech, in terms of equities, do very well. Long bonds, commodities across the spectrum. So the proteins that would be, hogs and cattle and things of that nature. The plants, cocoa, soybeans, corn, all that sort of stuff. The metals, platinum, silver, gold, those all are things that from a commodity complex are going to likely do well inside a stagflationary environment. Some people have asked, how do I know it's stagflationary in general? Outside of the fact of going shopping and look at the changes in prices of what have happened to various meats and plants and things that you shop for on a daily basis, oil and wood that you would use to build your home, or fill up your car, what you look at is what's happening with the dollar and what's happening with interest rates. So the narrative on most TV programs with mainstream financial has been this V-shaped recovery in corporate profits. I understand that the U.S. equity market has given what looks like a V-shaped recovery. However, corporate profits are nowhere near a V-shaped recovery, and employment is nowhere near a V-shaped recovery either. We're still dealing with depression level unemployment. And when you have depression level unemployment, there are second and third derivative effects that will come about. It just takes time and space for these things to develop. The US dollar is getting completely eviscerated because of what's going on at the federal government level. They are literally printing money like it's going out of style. And due to that, they're burning the dollar at the stake. And when you burn the dollar at the stake, commodities go up because they're priced in dollars. So there's an inverse correlation, right? So you're seeing it in oil, you're seeing it in all the things I just mentioned. So let me share my screens, give you some pictures of where we're at. The other thing that we're heavily focused on are emerging markets. We want to be in asset classes whose volatility measurements are low and declining. Bonds have some of the most historically low levels of volatility that we've seen. And so therefore we continue to work towards building our positions in bonds based on what's happening with interest rates. I want to see interest rates on the 10-year Treasury spike to about 0.65%. And if we did that, I would buy heavily into Treasuries across the curve, short, intermediate, longer term, but definitely longer term. I would continue to buy investment grade bonds. I would continue to buy TIPS, which are Treasury inflation protected securities. And then I'd buy some other elements that help to kind of create a kicker for those TIPS as well. But from the emerging market standpoint, the economies of this world that are in an economic quadrant that would be focused and experiencing growth, not only of profits, but economic growth and decelerating inflation. It's kind of a Goldilocks environment. Places that are experiencing that are China, Indonesia, Thailand, Taiwan, Norway, Finland. Believe it or not, Russia is definitely on that list. Greece, Colombia. I mean, these are all economies that are likely going to be within that more Goldilocks-focused type of an economic environment over the next few quarters. So we've got positions in China. We've got positions in Thailand, in Indonesia. We're working towards some of the other ones. We just have to wait for them to hit a mathematical low probability of movement. So every single day I get up and I measure and map probabilities of movement for indexes, rates, commodities, currencies, and I just simply wait to buy something until it goes through its processes and hits that low end of the range of the mathematical probability of movement. We then use some algorithms and a little bit of AI to help us identify the best timing and then move forward. And so when we buy it at the low end, we might sell a little at the top end, wait for it to come down, buy a little more, and then slowly build that position up to a maximum allocation. Maximum allocations for the portfolio are 12% in currencies. I can have certainly more than one currency in there. The euro, the yen, the British pound, basically almost any currency other than the US dollar are in a bullish trend. So if those hit an environment where we felt it was a good buy, we could certainly take advantage of it. Fixed income, max position per position would be 10%. So we could have 10% in short, and intermediate and long-term and corporate investment grade corporates all at the same time. And if interest rates spike to that 0.65%, that's kind of what you'll see. I do treat gold as a currency, so therefore the maximum position in gold would also be 12%. However, right now gold is experiencing a spike in volatility. And so therefore when you get a spike in an asset class, you essentially work down in your allocation to reduce risk. So let me just share these screens with you here real quickly. This is a picture of the volatility measurements of emerging markets. You can see that they're really quite low. And when you have a down day in emerging market like we did today, where they dropped slightly, about 0.8%, and at the same time, emerging market volatility drops, that's a good thing. When you take a picture of an asset class like gold that was up another 0.8% today and obviously has been on a tear, which we have owned for some time now, but volatility measurements for that asset class are spiking, this is an indication that it's time to reduce your risk. And so therefore I've pulled our exposure in gold way down. This hit 29 today. If it goes above 30, that's problematic and would not be surprising if it does. And if it does, you'll likely see gold go through a maybe 5, even 10% correction, which we'll take advantage of and buy more, increase our allocations to gold in a very heavy basis. It's sort of funny. Last week, Jonathan and I were chatting a little bit about gold and how all of a sudden it's starting to get noticed. And I said, well, anytime now you're going to start to see it focused on CNBC, MSNBC. You'll hear the news channels talk about it. You'll hear the Robin Hoods getting into it and all sorts of stuff. People will start asking you questions about gold. And sure enough, almost on cue, it's exactly what happened. And so now you get this spike. You get a spike in gold volatility. And when you get a spike in gold volatility, it's time to lessen your exposure. And so therefore we did that. I mentioned the emerging markets. We own China in two different ways. We basically are are exposed to China's main index. We also have some exposure to Chinese technology. When it is down, we bought this here on Friday. I sold a little bit up here today. I'm going to wait for it to come down, and I'm just going to continue to work into that asset allocation. Equity allocation maximum position is 6%. Commodity max allocation would be 4%. As I mentioned, currency and fixed income max allocations are 12 and 10% respectively. So some of the commodities that we're focused on within the plant type complex would be soybeans. Soybeans are working out much, much better than corn. However, corn, I think, will give us a little bit of an opportunity to bounce from here, and when it does, I'll likely work out of that. Coffee, working on that one. Wheat, working on that one. Cocoa, waiting for a little bit of a tap on what our low end would be on that. The protein complex, cattle and hogs, that one is certainly a good one to own, and we have that in our portfolios. Back to the emerging markets, you've got Thailand, you have Indonesia, and those are currently our long positions. I'm working towards Norway, Finland, if I can just spell. So these are the economies that are experiencing the likelihood of a what's called Quad 1 Goldilocks environment of growth along with decelerating inflation. And those are the kinds of scenarios that we want to take advantage of. Some of the metals that we own, copper, working on platinum, which is this one. Just waiting for it to touch the low end of my mathematical range, and when it does, I'll take advantage of and buy it. The bond side of things, here's longer term dated bonds, intermediate term dated bonds, investment grade corporate bonds, treasury inflation protected securities, and then something we call IVOL with a kicker, or TIPS with a kicker, which is basically treasury inflation protected securities plus some work towards protecting the portfolio based on what's happening with the yield curve. The Fed's going to meet tomorrow. Chances are they'll announce things like yield curve control. You might hear that. You might hear a discussion of NIRP, which is negative interest rate policy. Not sure they want to go there, but the bond market seems to think that that's the case. And I say that because when you take a look at interest rates, they've just, they've basically collapsed. Here's the 10-year Treasury. I'll get rid of some of this stuff so it's easier to see. This is the collapse in interest rates that occurred in the crash of the market back in March. And you can see interest rates are they're just continuing in this downtrend motion. If in fact we were to experience a V-shaped recovery in corporate profits and economic growth, interest rates would not be going down the way that they are. The US dollar would not be crashing the way that it is. Gold would not be on a tear. Physical commodities across the spectrum would not be on a tear, but yet they are. And so therefore it's a pretty easy confirmation that this is the beginning innings of stagflation. And until I get data to confirm that it's something other, that's how we're going to position it. I'll continue to focus on risk management, minimizing exposure to those asset classes with large degrees of volatility, move into those asset classes with low and declining volatility, and just kind of maintain that and then risk manage around those positions. So if you have any questions, let me know. Give me a call. I'm always happy to hear from you. 608-354-1977 or my email, chris@careformywealth.com. And thanks so much for continuing to let me to work for you. Any questions at all, please let me know. Hope you have a blessed day. See you soon.